Good morning, ladies and gentlemen. Welcome. Thank you for joining us. For those of you who are joining us for the first time and don't know me, I'm Danny Brown. I'm an agent at Compass in Beverly Hills. To give you some context, I've been doing this for about 19 years on the west side of LA. I started a podcast about 18 months ago called The Deal with Danny Brown. And what that is me interviewing successful elite people in real estate, business, sports, and entertainment, and sort of distilling their knowledge and getting advice and inspiration on their mindset, their work ethic, their grit, their passion, what it takes to succeed. So the podcast is all about educating and inspiring others to success and to reach their goals. So if you haven't tuned into that, please check out The Deal on The Deal with Danny Brown. You can see the video on YouTube, The Deal with Danny Brown, or you can see the audio on podcasts, on any podcast channels. We are charting on Apple Podcasts, which is amazing, top 250 in the world. We're being streamed in over 44 states and over 40 countries on every continent. So appreciate you checking it out. And if you like what you hear, leave us a 5-star comment, leave us a 5-star review and a comment. And that's my plug for this morning. But today we're here for something else. We're here for State of the Market, State of the Housing Market in LA. This is a series I started about 3 months ago at the beginning of Shelter in Place. Today I have two amazing, amazing guests, titans of the real estate industry, great guys, friends of mine. I have Tommy Beadel from Thomas James Homes. For those of you that don't know Thomas James Homes, which Tommy founded, they are the largest infill single-family developer in the country. They have anywhere from, I don't know who said that, but they have about 150 to 200 homes in development at any given time. Started in LA, West Side, that's the majority of their business, but they've now expanded to Newport, Orange County, Northern California, Silicon Valley, Seattle, and they're strategically looking at other markets to open in. Pretty impressive situation. These aren't tract homes. These are individual single-family homes in single-family neighborhoods. So he'll have a lot to say about what's going on. Our second guest is also a legend and icon in the business, Mark Cohen from Cohen Financial. He is regularly the top mortgage broker or mortgage banker in the nation and in California. He's seen many cycles, up, down, all around. He's done deals anywhere from couple 100,000 to a couple 100 million, I'm sure, and everywhere in between. Very complex, complicated deals. And he's going to give us a lot of insight on what's going on with the banks and the lending, et cetera. So before we get into that, I just want to address this is a very, very tumultuous, sensitive time in our communities. It's not my place to speak much on it, but I just want to acknowledge that. And as a real estate collective, and as a community, I hope we can all do our part to make things better, to bring more justice, to bring more fairness, to have some empathy and understanding. And hopefully those that are feeling the pain and the sadness, hopefully we can give them a little support. It's also compounded by Corona and shelter in place and all that sort of stuff. But that's all I wanted to say about that. And before we get into it with Mark and Tommy, I wanted to give you guys some context of what is going on in the LA West Side housing market. So the state of the housing market in LA right now is very interesting. The market has been very strong at every price point, including the ultra high end. David Geffen bought Casey Wasserman's home for $68 million last week in Beverly Hills. He had a warm, modern estate. David Geffen's estate, he sold to Jeff Bezos for $165 million. That was the Jack Warner estate. Bezos also bought Paul Allen's, the family's, the land they own for $90 million. There's been big sales in Bel Air, and Chalon, and Bellagio, and sales in Brentwood and Palisades. So really interesting because from the beginning of Shelter, the entry-level didn't miss a beat for the most part. The $1, $2, $3 million entry level was strong and still is, but everything else was dead for a while. But now everything's moving. And what I really wanted to point out is the middle market on the west side of LA, the 4 to 10 million, which has been in a slumber, has really picked up in the last 30 days. So we're seeing sales in Brentwood, Santa Monica, Beverly Hills, Bel Air, across the board. So does that mean that we're back to where we were pre-corona? No, not even close, not even close. But let's face it, with the unemployment and the shelter in place and the banking, with all the issues, we are still doing well. So compared to June of 2019, June of 2020, the sales are down the sale units are down about 58%. So we are down 58%, but last year was a booming peak year. Sales volume, total pricing, we're down about 50% from last year. But that's still a lot of sales considering shelter in place, civil unrest, all this stuff that we're dealing with. But that gives you a little bit of context of what we are experiencing. Things change day to day, certainly week to week. We don't know what the unemployment picture is going to be moving forward. We had the largest unemployment numbers, over 20% since the Great Depression. And then the jobs reports of the last few weeks have shown 2 million new jobs have added to the market, which was the biggest job gain since the Great Depression. Most of those jobs are retail, restaurants, construction, et cetera. So there's a lot of variables, a lot of moving parts, a lot of things out of our control. But as of right now, the market has seen some good velocity and a lot of sales. And we don't know if shelter in place or a spike in corona is going to create a new shelter in place in fall and winter. We don't know if there's going to be a vaccine by the early year. I mean, there's a lot of unknowns here. So there's a lot of experts saying different things and conflicting things. All I want to report on is the real stuff that's going on in the trenches, what I see now, and that's what this is about. So I want to turn it over. One other important thing. A lot of people think we're defying logic because there's no distress, and I'm getting a lot of calls, and we all are getting calls about, hey, where are the deals? I want 50% discount. I want a deal. And we haven't seen much distress yet. Now, there's been 5 to 10% discounts on some properties on average. But that's not on anything that's new. The new construction, I have not seen any decrease. And it certainly hasn't been any decrease in blue chip, high in demand locations. Or if there has been, it's been very minimal. Now, if stuff is B or C location or not great condition, or there's some negative issue with the house, we are seeing more than 10% discount. And I guess that makes sense. And then at the ultra high end, the over 20 million, which is rarefied air, we are seeing large discounts off the list price, but the list price are exceptionally high. So we're not necessarily seeing huge discounts off comps and last sales, but we are seeing some. And the higher the price, we are seeing bigger the discounts. So I don't know if more distress will come in sooner or later. Chris Rising, who I interviewed on my podcast, had mentioned that the government is basically underwriting the whole second quarter of the year with PPL loans and unemployment, this and that. And so we're basically punting whatever pain or distress we're going to feel into the future. So maybe in a year we'll start feeling distress, but we're certainly not feeling it now. And, it's really interesting. So I want to turn it over first to Tommy Beadel, who's got his hands in, I don't know, Tommy, how many homes do you guys have in development now? 150, 200?
Let's see, I'm muted. Oh, there you go.
Go ahead, Tommy.
On the west side of thank you. Appreciate it. Thanks for having me this morning, Danny. On the west side of LA, I think we have just under 200 units actively under development right now. And then, we have over 100 in Silicon Valley and just under 100 in Seattle now. So we have a lot of
400 homes.
Multiple markets. Yeah.
And what is the price range there? What is the low to high price range?
In LA, we range from $1 million to 10, kind of with the concentration in that 2.5 to 5 range. In LA, where there's just, there's massive demand for quality new housing and a lack of supply.
The bread and butter price point, but also a pretty wide swath of price points. So give me your feedback. What have you been seeing with your inventory over the last 30 days?
The last 30 days has been really strong. I'm going to back up kind of for the whole COVID over the last 12 weeks.
Start then.
Yeah, we slowed down. Obviously, March and April was slow. While everybody was just kind of trying to find out what was going to happen. Like you said, there were people out in the market trying to find deals, thinking they could steal things, retrading. And we stayed strong, stayed firm. But what we found in the last 30, 45 days is the market's turned back on because people need quality housing. I think what's really interesting for our business, and look, we only do, brand new construction homes in prime neighborhoods, right? So we have a little bit of a myopic view on the overall housing market because what we understand is brand new construction, right?
And the dirt and the teardowns.
And the dirt, of course. What I'd tell you is the dirt we're buying better in the last 12 weeks. We're finding good deals, better deals than we were finding, 4 or 5 months ago on the dirt, because people don't want to buy dirt right now. Competitors,
less competition.
Way less competition for tear down type homes, and a few reasons. The credit market seized up, which I know Mark's going to get into, but from a financing for spec construction type loans, the financing markets, the underlying leverage credit facilities with the banks, dried up. Liquidity is coming back into the market now, but it caused some challenges for other people. And look, we bought some great deals over the last 12 weeks, and we're still finding really good deals because there aren't buyers in the market that want to move into a piece of junk. They want to move into something nice that they can live in, which drives to where we're seeing increase in demand. I mean, we have more activity now, I would tell you, than we had in January and February pre-COVID, at higher price points than pre-COVID, because my theory is people that can afford to buy $2 to $3 million homes are still employed, are still making money, and they actually have more disposable income right now because they can't travel. They really can't eat out. They can't do all the extra things that they wanted to do. And if they're not living in really great housing, they're realizing I need a better house. And they're deciding to spend that money and upgrade their house. They've kind of been on the fence for a year. Do I buy? Is it the right time to buy? And now when you're stuck in your home and that is that's your safe haven, that's your sanctuary, you want it to be as nice as possible. And so I think we're really well positioned right now in the market, and we have great finished product that people can move into. And, we have homes that we're taking to market, and within a week, multiple offers over ask. We have homes that we can't even get to market because people want them before they go to market because they don't want to compete with them. And so, we've been really satisfied with what is happening. A lot of pre-sale activity, buying our houses that are under construction still because people want to customize them and really make their sanctuary their own. And they're okay waiting 3 or 4 months, 6 months to get in because they want it to be theirs. They want it to be dialed because they're now realizing this is where I need to put my money. The stock market's a little volatile. And so I'm going to put my money into a piece of real estate that I can live in and enjoy. And we've seen huge pickup in activity. I'd tell you in the last 30 days, we've probably sold $40 to $50 million worth of real estate.
Wow. That's amazing.
At great prices. We've done better than we expected going into them. So we're really pleased with what's happening in the market right now.
So question, and that's a great summary to break down to give everyone context, because you're in so many different price points and neighborhoods. When you said the dirt, you're starting to see deals. What would you say on average? Are you talking 5% discounts from what you were seeing before, 10, more, less?
Yeah,
I'm sure it's case by case, but if you had to give like an average.
It's case by case. When there's desperation, it's 10+% discounts on the dirt.
Yeah.
In the right spots. There's other places that there's no discount on the dirt.
Correct.
The dirt's actually gone up in value. Where we're seeing big movements in the dirt prices is when there's something happened. There's a desperate situation. Somebody was in escrow, something happened, and the sellers want to be done. That's where we're finding, great opportunities.
Opportunistic. Yeah. So you're not seeing a whole lot of that yet, though, in terms of distress, or are you? Because that's one of my theses. I haven't seen much distress where I'm looking at so far. It's been
not a lot of distress, but there's distress out there when sellers need to sell and they want the confidence of a buyer who's going to close. And so, we provide that comfort and are able to buy some good deals. It's not in scale, that's for sure. It's, isolated situations. And then other markets like Seattle's on fire. We can't buy dirt right now in Seattle.
Wow.
Because just massive competition from everybody else, end users. And so, it's case by case, market by market.
Would you say most of your competition now is end users and not other builders, or is it a mix of everything?
No, always. It's always been end users is our largest competition, right? I mean, that existing, we look at that existing house as a house, as dirt, right? And your clients look at it as a house, right?
Right.
And say, okay, how much do I have to put into this house to be able to live in it and enjoy it? And we're thinking of it just as dirt. And so we're always having competition from those end users. But something we're really excited about with that is we have a brand new product that's launching.
Oh yes, the $1 million product.
Exactly. We have a new brand at Thomas James called Trademark by Thomas James Homes. Trademark is our trademark. It's our twist on our finished homes. It's our spec project. There's no customization into it. We've done all the curated, wonderful design to sell great houses, and we have our first ones launching in Mar Vista. I think they're just about 1,500 square foot brand new houses, under $1.5 million. And so what's really interesting that we start to supply this product is we're going to supply a product to the people that are competing on the land against us. So think of it. If you have a buyer at $1.5 million, they can buy a 1,300 square foot home built in the 40s, or they can buy a 1,500 square foot home from me built in 2020 with a brand new 10-year new construction warranty. Which one do you want, right? Well, when they buy mine, they're no longer competing with me on the dirt.
Sure.
And so we can provide great new homes to buyers in those price points. And so we're really excited about that.
Will those homes have land or yards? You're splitting lots into two? Explain to me the concept.
Yeah, so they, depending if they're on an alley or not on an alley, they either have a front-loaded garage or a rear-loaded garage off the alley, and so they have front yards or backyards. It's just kind of different each one you go. But yeah, they've got nice outdoor space. They're detached single-family homes with their own APN. They're not condos, so it's a really exciting product.
What street is this, Tommy, in Mar Vista?
The first one we have is on Albright and Madison, on the corner of Albright and Madison. And we're actually doing a live event next week, Thursday. I'm going to look at my calendar. Sorry. Next week, Thursday at 10:30, we have a live event to preview these new homes. And so, really excited about
good plug, Tommy.
This brand. Thank you.
Touchdown, Tommy, with the plug.
Come join us in a Zoom call.
So I want to transition this to Mark Cohen, but before I do that, I just want to ask you, Tommy, and this will lead to Mark joining the conversation. What have you seen in terms of buyers' loans and restrictions and challenges going back to shelter in place 3 months ago? You can touch on that a little, and then we'll let Mark jump in and kind of give us the breakdown of what he's seeing in the lending world.
Look, I would tell you that we're not seeing much of a change from the buyers in the marketplace. Our average buyer on homes, we track this data very closely. Our average person buying our home is putting like 37% down payment. When you're putting that kind of money down, there's still quality financing out in the market for buyers. And so we found, really no issues in the last, 3 months with financing issues. The only other thing I would mention, Danny, that I didn't mention, I think it's really interesting what's happening in the market as well with COVID and where we're seeing demand. And then I'll turn it over back to you and Mark, is that there's all this pent up 1031 exchange money. So they extended the 1031 identification period through July 15th. And so there's billions of dollars sitting in 1031 exchange accounts right now looking for real estate. And they can't find real estate to transfer into because the inventories are low because people have pulled back. And so we see this increased demand, and we actually have some big groups looking at large portfolios from us that they actually want to come in and take a lot of the brand new homes that we're finishing. And actually, it's competition for the end users that want to buy these homes and live in. When an investor wants to buy them to rent them out because they have a 1031 to complete. And so COVID has caused a lot of interesting dynamics in the market that is driving up the real estate prices. And so, I know there's a lot of agents on this call. I'd tell you, get your buyers out, get them into houses, because stuff's not going to last. When we're putting it out there, it's going quick. and Mark's going to be able to finance every single one of them for us.
Yeah, well, that's interesting because I just lost a deal in multiple offers with a buyer because a 1031 exchange investor came in over the top and just blew us out of the water. So that's an interesting point. Mark Cohen, Cohen Financial. Thank you, Touchdown Tommy. You can hang out with us and give us feedback, or you can take off and sell some house. So Mark Cohen, Cohen Financial. There's no one that's done as many loans as you. There's no one that's seen as many complicated deals as you, except I see Steve Bram here, so he may argue. He's probably done a few complicated deals, and he's the king of commercial loans. But Mark, give us a little perspective on what you've been seeing going back to shelter in place 3 months ago, and what are things looking like now from the lending requirements? Are things harder? Are things easier? What are we seeing? And obviously we're talking about West Side LA, so it's very specific. It's usually jumbo, super jumbo. But go ahead, I'll let you take the stage.
Sure. Well, thank you for having me on. It's an honor to speak with everybody. It's been an interesting year in real estate and the world for that matter, to say the least. So just as a quick synopsis of what's gone on, if you remember January and February, the market started off very, very strong and everything was fine, and things were clipping on to have a record year in 2020. All of a sudden, COVID started, and literally for real estate sales stopped basically in its track for the most part. I'd say down about 70% for myself, which is a very atypical because my business usually has a band of about 10% each month. So it was down 70%, and I couldn't blame myself. It's like obviously it is what it is with what's happening, an unfortunate thing. So March was a slow month. There were a lot of cancellations. People were nervous, and justifiably so. It was just uncharted water for everybody. Starting in about mid-April, the market has picked up. But I want to step back, though, as far as how that affects lending. So in January and February, banks came out very aggressive, and the non-QM, which for those of you who don't know is non-qualified lending. That's for people who are loans are designed for people who are self-employed, who can't show tax returns, who qualify in cash flow from their business 12 months bank statements. And those are popular, and those are really heavily fueling the real estate market on the West Side. Because let's face it, a lot of people out here, they're self-employed and don't necessarily show what they make. That's a decent size of the market. Yeah. So literally in the second week of March, all the banks that had these stopped. So there were hundreds of transactions in Southern California, nationwide, where you couldn't get loans, and it just stopped. It wasn't, it wasn't a reflection of myself or the market. The banks who do these loans, their credit lines were pulled from were pulled. So the market had stopped in its entirety from that sector of the market, which is a popular part of it. So it hurt. So the markets had to regroup. So that took those people out of the market, and it's starting to come back now. But getting back to what's happened is, and you guys were spot on what you're saying. It's the last 2 months, I noticed a large pickup in activity, and it's very evident where volume is here for myself is at record levels, and I can attribute it to having a lot of flexibility that banks don't. Because, for example, a lot of banks, they've cut down their LTVs. Some major banks from 80% to $3 million down to 70%. So it takes a lot of people out of that arena there. So my value is I have a wide variety of people who do resources, who do the things. That's why our business is where it's at. But nevertheless, so the market right now, it's a two-sided market. People who are well qualified, and like Tommy said, it's not a problem getting financing. A little bit lower LTV sometimes, but not a problem. For people who have more challenging situations, can't show tax returns, it's coming back, but not to the extent where it should be, and where it will be in the next month or so. So it's a two-sided market. So the lending environment, people are aggressive. They want to lend, and they're just, you have to fall within the box. That's where my value comes in. Requirements from a lot of big banks for lower LTVs. I have programs 85 to 3 million, not a problem. 75 to 5, and sometimes 80. So it's there. It's just a matter of, the particular situation with each borrower. Let's see, price points. I think, Danny, you're right. The market's picked up in all sectors of the market. Initially, the lower price points, 750, 500,000 to 2 million were the strongest. Now it's caught fire all throughout the whole sector. What else was there we want to talk about?
Wherever you want to go.
Oh, and interest rates. Yeah.
Hey, Mark, what do you think? What do you think takes the QM mortgages to come back in the marketplace? Because I know a lot of these buyers, they're self-employed, that are buying these things. They need those non-QM mortgages.
They're coming back now. For example, one bank has it now. It's 55, 60%. The rates are decent. Others are starting to come back at 70. But there are restrictions, and they're tough to get through. They really are. Before it was real simple. My affiliate in New York, who's a big player in the non-QM market, and they have got they'll be starting in about 2 weeks. So you need just the forbearance has been an issue. You need just money from the banks to and from investors to want to invest, and they're getting great returns on these. So, and the ironic thing is, though, before the forbearance thing started, the delinquency ratios were next to nothing on non-QM loans. So it's just a matter of time and people feeling more comfortable, and the forbearance thing, and more in the background. But
what we're hearing from our side is that the mortgage REITs all needed to be shored up with liquidity requirements. So those mortgage REITs are now getting shored up, which is what's helping these non-QM loans, because they need to be able to lend them, but that securitize them and sell them off in the market, and they didn't have liquidity to get them sold. And so there's a lot of big money going into the mortgage REITs right now, shoring up, and you can see the equity markets on those mortgage REITs are coming back. So we have a lot of confidence that those non-QM should be back in full force like they were relatively quickly. So it's good to hear you're seeing the same thing.
Yeah, it's a really important part of the market for all of us. It just affects everybody. So it is a good sense, because you want to have stability in the market. You have to have all socioeconomic groups participating to have a strong market. Interest rates are, you have the all-time lows basically on Fannie Mae product, under 3% for 30-year fixed rates, 15 years, 2.5, 2 5/8, up to 7.65. So you're basically having the government heavily subsidizing the mortgage-backed security market, so which is good. So it's some restrictions on cash out. It's hard to cash out of banks. A lot of banks. I fortunately have a few. But for example, Wells Fargo or B of A, there no refinances, cash out period, or no refinances period at all. So the rates are low. Jumbo loans are high 2s, low 3s. So the market's definitely getting helped by low interest rates, and 3% for $1 million it's cheap. It's just cheap money.
Yeah. So to bring it down a level, get out of the high level discussion, what you and Tommy are seeing, and what I've seen, is that 3 million and above, you're needing 30% down or more. Is that pretty much the blanket statement? Obviously, there's different case by case scenarios.
I can go 75 to 5.
So 75 to 5. So you have those options, but most people don't. And have you seen over the last few months getting to loan docs and then lenders saying, "Hey, look, we're changing our rates"? So I was hearing about that. I haven't heard about it in the last 30 days, but I certainly heard about it 90 days ago.
I'm not happy to say that I've been in this business for 34 years, and the rates didn't change, but I had 2 deals, non-QM deals, and that ready to close, and their warehouse lines got pulled. So
were those recently in the last few weeks, or are we talking 3 months ago?
Those are back like all the same forgetful day, mid-March, like March 17th.
Yeah.
So, sorry, our warehouse lines got pulled. Nothing we can do. And other banks that did that to me, they funded it because I have a strong relationship. I forced them to do it because I had about 10 deals in one place. But it's not happening now. But because the rates are locked in, and I do business with that 4 or 5 places, so they're not going to really play too many games with me.
And to add to a little bit what Tommy's saying, I'm curious, what are the high demand price points that you've seen in your transaction loans that have come your way over the last 6 weeks or so? Is it all over the board, or is there like a sweet spot that you're seeing most of the purchase prices come in?
I'd say very heavy demand, 1.5 to 2.5 to 3. Yeah, that's for the most activity.
So that entry level, which is just so hard because we had limited inventory coming into Corona, and then sellers withdrew listings and deferred listing during the spring. I know, Tommy, you had said to me, this is probably a month and a half ago, that you felt there may be a deferred market in the fall and winter, all the people that were supposed to list during the spring that are going to come on. Do you still feel that way, Tommy, that there's going to be inventory coming on fall and winter?
Tommy?
I don't actually. What you're finding is the reason people aren't selling because they have nowhere else to go. Even out of a home you're living into, you got to move somewhere else, right?
Sure.
And people are now hunkering down because they don't know. There's a lot of uncertainty. There's a lot of negative press on, you should be fearful, and so people, when there's fear, people stop, they freeze with fear, and they don't do anything. And so, I don't think there's going to be a glut of supply come on, and again, I come back to, I have a myopic view because we only have new construction inventory. We don't worry in our markets because in our markets, there is no supply of brand new homes. It's not like Toll Brothers is going to come drop 2,000 new homes in the west side of Los Angeles. That'll never happen. Right. So there's always going to be supply constraints for brand new houses. And there's always demand for great quality new homes. There's LA is a housing stock short. It's a starved market for quality housing stock. And so, for what we compete with, we don't see a glut of inventory coming. And I don't think generally in the marketplace, you're going to see a glut of inventory. We track trends right now on how much activity is on the market, what days of supply. There's multiple neighborhoods. We track them by neighborhood. In neighborhoods, there's negative inventory supply, negative month supply right now with how fast things are moving. And so, I don't see that changing anytime soon because, again, the fear is not going away. And that fear is it's still freezing people from doing anything. And when they do, there's no sellers in the market because they're frozen with fear.
I agree. It was said before because I think you've seen a whole shift in dynamic to people's mentality. People have had time to spend at home the last 3 months, and they realize that a home is really important to them. So they want to make their home as comfortable as possible, and if they have to spend the extra money, they'll do it. So I think the dynamics in people's mentality has changed. With heavy focus is on being home, and it's a hassle even to go out to a restaurant now, and the menus and this and that. And it will change over time. We'll get back to it, but people are like the easiness and the being comfortable at home. I just think that's a trend that's here to stay. And so
I'm going to ask this.
Spend extra money and so forth.
I'm going to throw this out to both of you. What does your crystal ball tell you? What is your thesis for the second half of the year and the first half of next year in terms of what we're seeing? Is this momentum going to be short-lived, or do you see it being a healthy market, or are you seeing us getting bombarded with distress at some point and there becoming a slowdown? Obviously, there's so many moving parts, and it's impossible to know. But you guys being in the trenches at the level that you're at, I'd love to hear your take and see what your crystal ball says.
I think that it's defied logic what's happened so far. Because if you told me this, I wouldn't believe it. So I think you've got to be cautious going forward here because prices are going to be expensive and so forth. It's being offset by lower rates, but a lot depends on the economy. The bottom line is here: you go up and down. I'm just out here on Wilshire and Rodeo, and the stores are, obviously they're still closed, and a lot of retail restaurants, they're hurting. And you go to restaurants here, and they're 20% open. So, it's only a matter of time before these things are going to really hit once this PPP money is done. So, I'm just thinking, and I'm not trying to be negative at all because I'm not, but you could have a repercussions from all this hoopla having an impact later on. I don't think it'll be terrible, but we'll work through it. Bottom line is that LA is a place where people want to be. They feel comfortable. Sure. It's a dynamic city. So many different industries, and I just can't see it changing. There's always going to be bumps and up and down bumps along the road, but I think it's more the same overall. It could be a slowdown though, but temporarily.
Tommy, what is your feedback on that? I think it's great, Danny. You got two completely different opposite views between Mark and myself. Mark's it seems like cautious there, and I'm the optimist always in the situation. That's just my nature. I can tell you markets are driven by supply and demand. Period. End of story. There is no supply and the demand is only increasing. People realize the need for quality housing because, like Mark just said, the restaurants aren't open, the retail's not open, you're not going to go get on an airplane and travel. Right. So what are you going to do? You need a great home to be in.
You're hanging out at home.
There's our plug. And you're hanging out at home. So you might as well invest in that great home. And so the demand's increasing. More people want better quality housing. And the supply is shrinking because people are staying put of what they have. And so when you have those two, kind of opposite ends, what does that do? That drives up prices. Supply, somebody asked me, do you feel like we're going to have what came in 2008? Do you think we're going to have distress in the markets like before? You got to remember in 2008, there was massive supply because the banks were taking it all back. And you remember back in all the REOs that came on the market, that supply and oversupply is what drove down the market. You also in new construction, you have new construction is off in the permit over the last 12 years, especially in California. It's gotten harder and harder to get permits to build, more and more regulations, more expensive to build homes. And so that's driven down the supply of brand new construction. In 2008, it was some of the highest periods of supply of brand new construction across the country. So you had this, these two forces of providing huge supply, and then the demand came out of the market because the mortgages came out of the market.
I agree.
We're in a completely different position today. We have massive demand and zero supply. And so I think the markets through the latter half of the year are going to continue to push up. We're going to continue to sell homes. We're seeing demand at every spot. The last thing I'd say, and then I'll let you go, Mark, is that we're also seeing huge demand for people to build homes with us right now. We build brand new houses for people on their lots with our, Build on Your Home site program. Guys like Mark can finance that for clients. We take referrals from agents to build these homes. We see people saying, look, I know I'm here. I love my lot. I love my location. Now I'm ready to build a brand new house. And so there's massive demand because if they can't find it, they're going to build it themselves. And we're here to solve that need too.
Yeah.
No, I think you're 100% right. The one thing between 2008 and 2020 is in 2008, it was an economic situation, which was out of control. The lending and the economy were just out of whack and just didn't make sense. And this one was caught everybody off guard. It was a pandemic. It was not economically driven at all. So that's why this thing will bounce back quicker. And I agree that the banks are in sound financial shape, and that will help And you're starting to see with the quick rebound, a lot of the economic numbers are coming back in.
Yeah. Well, I hope you're right. The optimist in me says, yes, it's going to keep going. LA is the place everyone wants to be, and people with money are still people with money and will still be buying. The realist in me says this is defying logic. And at some point, we're going to have to pay the piper, and there's going to be some distress from unemployment and people losing businesses. But who knows? I hope you guys are both right. I hope that is the case. One other thing, Mark, I've been reading a lot about is that the equity positions in single-family homes are much higher now in 2020 than they were 2007, 2008, like dramatically different.
Not even, you're 100% right. Not even close, because in those days it was 95%, 90%.
Or 100.
People, yeah, that's it. Oh, that's a thing of the past. That's a nice.
Negative AM, Mark? Negative? You can't do a negative AM loan at $7 million?
Actually, there was a while, 103% loans, I think.
Okay, I'll take the 3% on the $7 million.
Yeah, exactly.
So the equity positions are much higher.
Yeah, they're much higher. And basically, people as a whole, and I know I'm generalizing this, you have a lot of wealth in this country now, more so than, or in this city, more so than ever there's been. So people are putting down large down payments or paying all cash for houses. And I think from that standpoint, you're not going to have a problem with short pays or those types of things.
At least it will mitigate it, whether it becomes a problem or happens or doesn't. At least it's going to help mitigate it, because it's going to take so much longer for people with good equity positions to get into distress. And banks may not be so quick to take things back when there's so much equity in it, et cetera. So hopefully we've learned from last cycle some things, and hopefully the conditions are a little different. Hopefully there won't be a severe snapback with Corona. Hopefully we'll get through these tumultuous times. Anything else you guys want to add before we move on? I really appreciate your time. I know you got files piling up on your stand-up desk, Mark, and Tommy's probably got buyers lined up out the door. There. Anything else you guys want to say to our listeners?
No, I'm always available, and it's a very nice honor to be invited on your show today. Very well done, I might add, and very informative. And Tommy, thank you for getting your opinions on the market, which I know you're very successful, and you know your business for sure, and the optimist. So it's been an honor to be on this program.
Well, always an honor to hear you speak. Touchdown, Tommy. You got anything to say before we wrap up?
I'm honored to be a guest on your show, Danny, and to be able to sit and chat with Mark, to be held in that high esteem. It's an honor for me to be with you guys. Excited to do more business. I know there's a lot of agents on this call today, that I know. And Mark knows, like Mark said, we're just a phone call away. We're always here to help you guys. Anything you need to continue to drive your business, any questions you have about what we have, what's going on in the market, Thomas James is here to support you, just like Cohen Financial. And so, Danny, I appreciate you inviting me on the show today, and look forward to talking to you guys soon.
Yes, appreciate the feedback. I'll just give another quick plug. If you haven't listened to my podcast, The Deal with Danny Brown, which also incorporates the state of the housing market, please do. You can find it at Apple. You can find it at Spotify, Google, wherever you consume your podcast. And the video will be put up on YouTube. Let people know about it if you think they'd be interested. And we really appreciate you guys spending some time with us. Mark and Tommy can't have better guys in real estate talking about true data and real life experience and what's happening. You guys have seen it all and done it all, and I respect and admire both of you and appreciate it. And I'm going to have another panel soon in the next couple of weeks, and we'll talk more about what's going on then in the next 2 to 4 weeks. So appreciate it, guys. Have a good week, and we'll talk soon.